Hi, Amelia. I want to welcome you to our community. I really appreciate you taking the time out of the day to be with us. I'm now making you the presenter. And as you'll see, you have the ability to share your screen and turn your mic on. Let me just make sure your mic is on.
Can you hear me? Hi.
I can. Hi, Amelia.
Awesome. Hi.
Very nice to meet you.
Yeah, nice to meet you too. Thanks so much for the invite today. I'm excited to be here.
Well, Joe Perry suggested that I reach out to you. I'm so glad you reached back, and I took a little look at your website, and nice website, and
thank you.
You used to have your own show on CNBC.
Yeah,
you know,
did.
So what I like to do though, Amelia, is take people and traders and educators and analysts back to the beginning of their career and find out how it happened for you on the long and winding road of becoming a trader, mentor, educator. How did it start, and who were your influences?
Sure. Well, let me just start. I have a similar background to Joe Perry, which is exciting. I'm not a technical trader, but we both come from more the institutional side. He was at F.A.C.E Capital for a while, and they were a client of mine for a long time. Anyway, this is Market Compass. It's based in New York City, and this is kind of my background here. So what happened was after college, I was an economics major. And the Federal Reserve Board was looking for someone to start. It was Asia financial crisis. And so they hired me to come in. 98. They hired me to come into, it did start in 97, the Asian financial crisis. They were already a little bit in. So they hired me to come in, and I worked in the international division, the international finance division, for a man named Ted Truman, who was kind of a mentor to Alan Greenspan. They would consult a lot with each other. And, he's had a big career in international policy making. But in any event,
did they teach you how to carry a briefcase?
Actually, I was in charge of delivering Greenspan's briefing books ahead of the FOMC and the G7 meetings. So that was, I would take a little bit of a car ride to his house, and we dropped some briefing books off for him. So I coordinated the briefing books. So it was really cool. It was a very fun experience, and it was very international, and it was an exciting time. And the reason why it was an exciting time, I kind of wrote this on some of my Instagram pages. It was the introduction of the euro, my first year at the Fed. So, January 1, 1999, that was kind of like less than 1 year in for me. The euro was introduced, and, we just had the 20th anniversary clearly this year. And it was such an exciting time. And having just graduated from college, I didn't really realize the enormity of the situation, how important it was. But it was so interesting to me, that I wanted to stay in foreign exchange, and I wanted to continue that as a career.
Do you remember the price of the euro when it was launched, Amelia?
Oh, I'm trying to remember. I think it was like 118.50 or something.
Yeah, I'm kind of thinking the low was around that time period, about 85 cents or 88 cents.
Yeah, it was like the average when it just came out, though. And then I remember like a year or two later, the physical currency was introduced. And I remember there was a lot of activity like around the Fed thinking like, would the euro coins work in the Paris subway? And, just things like that they were really worried about. And yeah, it was such a cool time. And so a group of those people, after I had been there like a couple of years, left, and they went to Wall Street, and they took me with them as an analyst. And I ended up at Deutsche Bank in its early days in New York City. And then basically I just stayed in Wall Street for the rest of my time. I never realizing that that's what I would, not having that intention when I began, but that's what I ended up doing because I loved it. So I was in the economics group, and I moved to the foreign exchange strategy group and foreign exchange sales and trading.
Wow, God, you were blessed and fortunate to have taken that path. The path that a lot of people have to take is, become self-taught, and they go on the internet and they're looking to learn, and there's a lot of charlatans out there. You were rubbing elbows with the best of the best at the Fed. Deutsche Bank, weren't you?
Yeah, I was really fortunate. I started at Deutsche Bank, and then I went to 2 hedge funds. So I went to the buy side where I did some trading, and then a UBS, Swiss bank, picked me up as its head of foreign exchange strategy for the Americas. And so I ran that, and that was a very tumultuous time. But it was a cool time to work at UBS because it was the European banking crisis and the Greek crisis. And I was at a European bank. So that was like, big deal to experience there. And they also put me on the commodity research board there, which was very exciting. They're one of the world's largest gold traders as well. So that was kind of cool to learn and see about that.
No,
UBS.
Okay.
So, they have all the gold vaults in Switzerland and in Singapore, and it's really, really interesting to see that. And
does the U.S. have any gold in Fort Knox?
They do at the New York Fed, I know.
Oh, okay, that's right.
Yeah, for sure.
Yeah, well, after 9/11, they were worried about one of the towers or in the basement.
Yeah, I think during 9/11, because I was not at the Fed, but I was downtown on the day of 9/11. I was working at Deutsche Bank. What happened was, I think the Fed, to protect people, put them down in the vaults. Actually, the staff, and so, but they were safe. And but in any event, I think at that time they stopped the public tours of the gold vaults just because security downtown too. So
is that one of the instruments? I know sometimes, what you cut your teeth on is something that you become an expert in and get a feel for. Is gold one of the instruments that you're still fairly active in and follow?
I follow. I haven't been too active in it. I just find currencies are more liquid and easier to get in and out of. But I'm a G10 currency specialist, and I feel like that suits, the retail community a little bit better because, the carry is, it's very hard to, like, say, short Argentina. It's so expensive, or, and it's so illiquid too. So my background has always been G10 markets, and I've never. This is my first entry. This in CNBC was my first entry into retail trading. I've only, been on Wall Street, and I've only ever dealt with institutional funds. But the fun thing about being on Wall Street too was, when I worked at UBS, especially, and at Westpac kind of after that, I got to talk to all of the major hedge funds in the United States and real money funds, because they all traded with these banks, especially UBS. We were the second largest foreign exchange trader in the world at that time. And as a matter of fact, 2/3, we were in Stamford, Connecticut, 2/3 of the world's South African rand came through our Stamford, Connecticut trading floor in the New York time zone on a daily basis. So, basically, if South Africa wanted to control the currency, they needed to call the desk at UBS to intervene or whatever they wanted to do. So it was kind of, the flow we saw was gigantic. It was really exciting to see that. But it was also great to just talk to all these hedge funds and real money funds to not only figure out what they were doing at the time, but more importantly, and which applies now, was to get a feel for how they invest and how they look at markets, because the framework for how they approach markets, because that's something that even if when markets change, you can still look at that framework and you can still learn from that and apply it going forward. And so that's kind of what my company, Market Compass, is about. I want to take the very large institutional and hedge fund frameworks that I've learned off of, and I saw the best, hedge funds in the world trade off of, and I want to apply those and teach those to, a retail market. So
I am a big believer in communities, number one, and number one as well, tied as intelligence gathering. Do you still bounce ideas and exchange market views with a network of people that whose work you respect, and
for sure.
and include that in your equation for trading opportunities?
Yeah, for sure. I mean, you never want to just have such a strong view or narrow viewpoint that you don't see the risks around the outlook. And so, you always want to have that friend or that person in the market who disagrees with you, so you can see maybe the holes in your trading theory or where things could go wrong. We would look a lot like that for those things, on an institutional trading desk, because while some people call traders risk takers, they're also known as risk managers. So when you take a risk, you then have to manage it. And so you need to know all of the, things that could go wrong around it. And so I like to talk to people with contrary views to mine, actually, to see, okay, where could this go wrong, and to prepare for that and hedge against it maybe. But yeah, for sure, I talk to a lot of people on the street and get and get their views. And they're so helpful. I worked at a lot of European banks. I worked at Deutsche and Swiss. So with all of the things happening in Europe and Brexit, I have really good friends in the UK and really good friends throughout Europe who, they're on the ground, so I can get kind of firsthand information like, okay, this is what we're reading on the BBC, but what is it really like in London right now? How are people really feeling about Brexit? What's going on,
Yeah. Ever crossed paths with Mark Chandler? He's been on the street. Yeah, Mark, excellent FX analyst. So, very good timing for you and I to be talking, Amelia, and from the ECB. What are your expectations for what Draghi's going to do, considering, we've had some softness in European data? Do you think he's going to backtrack on when QT may begin in Europe, just like the Fed did? And do you have any view as far as directionality in the euro? Because it's been sideways forever. It's been sideways forever.
Yeah, so we have some market themes, and one of them is Europe, but these are the market themes that we're really concentrating on right now. The US economy and just where it is in the growth cycle. Are we late cycle or are we kind of mid-cycle? Because that matters, especially for commodity currencies. The China economic slowdown, which matters very much for Aussie. And of course, European political uncertainty and economic slowdown, and Brexit uncertainty. So since you asked about Europe, let me just forward here to Europe. Okay.
Oh, thank you so much. A PowerPoint.
PowerPoint.
Put some time into it.
For euro. Growth is slowing in Europe, and Draghi's going to most likely, obviously, acknowledge that, and inflation is slowing too in Europe, and he's going to acknowledge that as well on Thursday. So there's downside risks into the meeting or the policy announcement on Thursday for the euro. There's still uncertainty whether Italy can meet its fiscal targets. And to your point, the central bank did end its quantitative easing in December 2018. It looks unlikely that the ECB is going to raise its policy rate anytime soon. It had thought maybe August, but that doesn't look real. Now, what people are talking about, the big macro hedge funds are kind of talking about out there, is the ECB is risking a policy error. And so for people who've been in the market a long time, the macro people, they are equating what the ECB is doing now to Lehman Brothers in 08. So they're thinking the potential error that the ECB is currently making by withdrawing the liquidity, ending it in December 2018, and kind of talking about the hike or a potential hike, is similar to July 2008, when the ECB delivered a 25 basis point rate hike just before the collapse of Lehman Brothers in September. So people actually think that the ECB is making a huge error here. And
that's an interesting view. Everyone believes what happened to Lehman was based upon bad paper, the mortgage market, secondary mortgage market, the housing bubble. And you're saying the icing on the cake in 08 was ECB delivering a rate hike right before that.
Yeah, it was just a big collapse. I think people were warning ECB, and certainly the US and the Fed was already cautious, and the ECB knew that, and they were like, nope, and they went ahead with that rate hike, and it was a disaster. They had to reverse it. It just was such bad timing, and they seemed to be operating with blinders on. And some people, especially in the big macro hedge fund community, are questioning whether they're doing that this time around as well, because there's been talk out there in the market, just among economists and just among people, just in the news and on TV, that, US growth is slowing, or we're growing less rapidly here in the United States, and now Europe is going to pick up and be the engine of growth. And when has that ever happened? If the US slows, everything else generally slows too.
Yeah, they used to say if we caught a cold, the world catches a pneumonia.
Exactly.
So when you think about this, instead of a Lehman collapse, since the balance sheets of most banks in the U.S. Are much stronger, could the collapse be something like banks in Italy that are way underfunded, or Deutsche Bank with your old employer that has the largest derivative book in the universe, in the cosmos?
Exactly. There's just a lot of risks, all the ones that you just pointed out. And also, in May, there's the European Union parliamentary elections coming up.
Yeah.
And that's a big political risk, because these kind of populist parties are gaining in popularity at the polls. And the reason why that is a little bit of a problem is because these populist parties tend to be Eurosceptics. They want out of the euro. And so that's not good. And whichever parties are, come to the forefront in this election, they're going to shape European policymaking for the next 5 years. And so the market's quite worried about who's going to get elected. And so that risk goes through May. So if we take a look at this Euro chart here, we just see topside resistance around like 116.40. That's that white line. We're obviously holding support pretty solidly at 112. But where can this go? We just take this back to a 5-year chart, and we see that low in 2017 of 103.41. And basically, I'm calling euro is going to move to parity. So we like to look in global macro at big directional trades. So you can play this over like a 6-month view. And so we try to look for, big themes, and we track the themes that end up, being a big directional trade. So where is the potential to have one?
Okay, so that's a bold forecast.
Yeah.
And you're also, besides a risk taker, risk manager. So what would change your view? Would it be a breakout over the top side of the triangle, rectangle you were showing before, back over 116? Would change your view, at least intermediate term?
It would more have to be news. I mean, if you're trading shorter term, yeah, if you're like trading, 1 week out, of course, if we break that 116.40, you want to not be short the euro at that time. But then, you have a top side, another top side here at 118 here, 118. But, just on the 6-month view, it would really take news, some sort of economic, or, either the European economy would have to strengthen, maybe the US economy would strengthen and take, Europe with it. Maybe the US economy isn't slowing as much as people think it is. And we don't really know right now because we're in data shutdown. We may not even get the GDP data because of the government shutdown. So, it's just a lot of risk right now. I don't really see something that will turn it around near term, but of course you need to really watch the headlines.
Yeah, everything can happen. So this is a 6-month view for parity.
Yeah, this is a 6-month view because I want it out beyond that May EU parliamentary election for sure. And I think, not beyond tomorrow's rate meeting, when I do think Draghi will be dovish and it will impact euro negatively, I think, they'll continue to be more dovish, and maybe that policy error will become more apparent over the next 3 to 4 months.
Yeah, I was thinking, 105.80 is a breakaway gap that we had after Macron was elected. Might be an area, but 78.6 back, something like that, or the rally from 103. But you see that gap there in 2017? Go to your right a little, one more. There you go. You Amelia, you don't get a lot of gaps in FX because of
True, yeah.
You get gaps in IBM and stocks, things that closed, but FX money never sleeps. Well, FX only sleeps on Sunday.
Exactly.
So, all right. So that's a pretty bullish view for the dollar. With what's happening with Brexit, if the euro's going to parity, is cable going to under 120 towards 117?
Yeah, here we are with Theresa May, and she seems to have 9 lives. She looks upset.
So sad.
I know she does. She doesn't have a lot of reason to be happy right now. So
I feel like
she's got 9 lives. She keeps winning. Every time you think you're going to count her out, she's right back in the race. So it's she's a very interesting figure. But I just want to let's just briefly look at
that is cool.
The 2016 stuff. So here we are, just to review, June 23rd, 2016, look at how euro this sterling just gapped. See, we stopped right at 150, the figure, because everyone on Wall Street was really positioned for the referendum to not go through. And so they thought this would break topside 150. And of course that didn't work, and it plummeted. Very dramatically. And here is the G10 on the day, just a 1-day change from the referendum to the day after the referendum. So yen, the safe haven currency, strengthens, everything else, falls. So you could have been short like any currency that day and done really well.
Right.
We lost 2.1 trillion in the global stock market overnight that night. So very dramatic. And now currently, let's just take a look at what the Bank of England is saying.
Oh, yeah, Carney's scenarios. Go ahead.
his Carney scenario. So he issued a financial stability report in late November of 2018, and it was very, very dire. It got a lot of press coverage. And so here, if you read the last sentence here, this is taken directly from the Bank of England's financial stability report. It also sees the pound in an unprecedented collapse to below parity with the US dollar. This is the forecast for a no Brexit, and no negotiated Brexit outcome. They're going to leave a hard leave, basically. And so, that's really scary. And it also just gives you a sense of the magnitude of the risks around what's happening right now. And it's not the base case forecast, but of course in macro, we always want to look at the risks, and we always want to look at if there's a big directional move potentially coming. We just want to highlight it and what we can do, because moves like this clearly make or break a trader's year, and they can make or break a trader's career. You know what I mean? Like if you were trading on Wall Street and you missed this move, like if you missed the sterling short back in 2016 on the referendum day, and you were an FX trader at a bank or a hedge fund that day, you lost your job, because your only job was to make money or protect the bank that day, or both. And if you missed that opportunity, the biggest one-day move in sterling, like in the history almost of the currency, then that's not a good outcome. So we definitely just want to highlight here, and this isn't clearly my forecast. This is the Bank of England's forecast, so that's something to pay attention to.
Okay.
We broke topside 130 this morning here on sterling. We're holding support at 128 the figure. It's just that there's hope that March 29th deadline, when they're supposed to leave the EU, is going to get pushed back, and so that's why sterling is rallying today. I don't really care. I mean, it's just trading idiosyncratically on headlines. We also see headlines on Bloomberg this morning that Theresa May doesn't want to push the date back, that achieves nothing. And so you're like, oh no, every time I feel like Parliament tries to do something to negotiate and make the Brexit exit a little bit better, Theresa May takes a hard line. And so far she's kind of succeeded. So, you don't really know what's going to happen. I think the best case is that they push that March 29th deadline back, and at that time sterling would rally. But still, there's just so big of a range of multiple outcomes that could come that people are super nervous about sterling. And here you just see 2016, that was the day of the referendum, how it fell. And this was like a flash crash in October of that same year. And so that's where I'm targeting sterling down here, the 120 level. And I think it could even move lower. It should, we have a messy exit. And so that's just something to watch. That's just something to continually monitor those headlines. When they turn increasingly negative, you're going to see the pound really react negatively. And the reason for that is because traders don't want a repeat of 2016, when some of them missed that collapse in the pound. So once the headlines get really negative, people start loading into those short positions, because
so that's why the market has a memory, because traders do.
Yeah, exactly. Because that really, so many people miss that trade, and it really, it's instructive. Maybe those people aren't working, they lost their jobs at that time, maybe they're back in the market, but for even newer traders not trading at that time, that's like epic. That was a huge event, and it's rare in macro trading that the same event happens twice. And here we come again. We're still doing Brexit, and there's still no outcome in how the UK will leave the EU, and we have a date. We have March 29th, and we're watching that date. And you kind of have a roadmap. It's amazing how long
they've stretched it out. It is amazing.
Exactly.
So, Amelia,
no one wants to miss the trade again.
Yeah, you don't. No one wants to miss it, and I miss trades every day. But you're right. You're talking about no one wants to miss home run days. If they get the pitch right in the zone.
Exactly.
Coming from the hedge fund community and your background on Wall Street and hedge funds being part of the COT report, I'm wondering if that commitment of traders report, if that is also something that you integrate into your analysis or ignore.
No, for sure. I mean, I use that positioning data. I also get proprietary positioning data. I get the public data from the commodity board. But
right, the FTC,
I also get some proprietary data from some of the large foreign exchange trading banks, like on their clients, so they can show like real money or hedge funds have flipped, and that data is more timely. It's like it's released a couple days a week, so sometimes we can get ahead of that data just by looking at client flows at some of the banks, which I have access to. And yeah, that's very important. It can tell you, when a long, or you can tell you when a short is very, very extended, that, you're risking seeing a short squeeze. Or,
what's your philosophy? What's your philosophy on leverage? You talk about missing trades. Isn't it easier to not miss trades if you reduce the leverage, and you could not have a 50-point stop on a macro trade? Don't you really need to, risk 200, 300 pips on a pound or euro trade to be there for an event?
Once again, it's about management. So instead of, I think the retail community, or my experience with the retail community is, even as we're discussing right now, even how I'm discussing this right now, is we tend to look at trades like one by one. And more in the hedge fund space and in the banking space, you look at a portfolio of trades. And so you would allocate leverage to different trades. So right now, say if I had a 6 month, if I was short sterling if I was short a sterling put like 115 6 months, and I was short a 6 month euro dollar put at like say 110, at this point I would allocate about 75% of my resources to the euro trade, and I would allocate 25% of my money to the sterling trade, just because right now sterling is so idiosyncratic and it's just trading off headlines, and we don't know what's going to happen. As we get more information on sterling as to what might happen, then we'd put more money towards that trade. But we just don't have that information right now. So that's kind of how we look at it. We're never really trading just one at a time. We're kind of trading as a portfolio. But you're right, in macro, which is a little bit scary, I think, for retail, and a little bit scary now as an individual trader, as opposed to having, a bank behind me or a hedge fund with other portfolio managers with me. And, like sophisticated risk systems that we can tell everything. You do want to swing for the fences for macro trades, but you have to, just pick one or two, and that's what you want to go for. You can't certainly do that with every trade you do. That's not going to work at all.
Okay, so let's say that both your scenarios work out. They imply, weaker sterling, weaker euro, much stronger dollar. So does that kind of put you in a deflationary camp for almost all assets, because the stronger dollar really is deflationary? Could put pressure on commodity prices, emerging markets.
What's really going to put prices on commodities and emerging markets too is, in general, like the U.S. and China simultaneous slowdowns. That's really, really tough. If you just want to look here at just a couple charts on China. So, the China growth slowdown is really impacting the Australian dollar. And they're also in a housing slump in Australia. If you just look at, this is the white line is Aussie dollar, and that's that flash crash. But here is renminbi, dollar renminbi. So it's inverted, so high and low. So as this is moving lower, renminbi is getting weaker against the US dollar. Basically Aussie can't rally as renminbi is getting weaker. It's not really possible. As it weakens, it drags Aussie down with it, because it's kind of a growth and commodity story. Copper prices have been trending down as well, which is bad for Aussie. And then if you just look, this is kind of like a macro thing people are watching. This is 7. This is the same chart. So renminbi's inverted. People are just watching 7 on renminbi. And, if it breaks, that's a huge level to break. And that'll take Aussie, the night, I'm saying the evening it breaks, because that's when they set the reference rate in China is our.
Are you looking for that to happen? That has been the trend, and
that's been the trend. They're coming back up, and we have trade negotiations, so they probably won't depreciate the currency during the trade negotiation. They kind of play around with that, but you don't know how those trade negotiations are going to go. You don't know how much more China is going to slow, but certainly if it slows, they're going to let the
You know, as a commodity broker and trader for a long time, I always watched what the Chinese were saying, because they're always doing the opposite. They would announce that they're, you know, buying bonds when to create a rally to sell into, or they were selling corn or soybeans so they could buy it cheaper. And their most recent statement about the yuan was that they wouldn't weaponize it. So I'm thinking eventually they're going to weaponize it, and you're thinking that if the trade wars intensify, that's when we take out 7.
Yeah, and that's really bad for Aussie. I mean, it's pretty hard to trade renminbi, but Aussie's trading along with it, and it's very liquid, and that's what you want to do. You hear they're setting the reference rate even close to 7, you know, like 6.9, and you know 7 we got down to at one point, or if you want to say up to, but yeah, traders are watching it super closely, and you know they're going to put on Aussie shorts immediately when that happens. And so here we just take a look at Aussie. There's that flash crash at 67.41, and then I'm looking down to the October 2008 low at 60 cents. So you know there's not much between that flash crash. There's not much here.
Yeah.
You know,
I know some people even talking 40 handle if that happens. So, you know, I'm going to have to thank Joe after this for introducing us, Amelia. It was really a great presentation with some macro views, and I think it's CNBC's loss that you know, I don't know what happened, but that they're not using you, because your knowledge base and communication skills are, you know, top-notch, elite, and like it or not, like it or not, you're now my trading warrior sister, and really a pleasure meeting you, and wish you great success on your 6-month forecast, and would love to have you return down the road.
Thanks. Yeah, sure. I'd love to come back on. It was so fun talking to all of you. I love talking to the retail community. All the traders are so nice and so knowledgeable and so fun. This is my website if you want to find me. And if you just hit get the guide now, you'll get free content, and you'll also get notices about when I'm speaking and when new products are launching.
Okay, so I encourage people to go to www.marketcompassllc.com. And you're not that active on Twitter, but your Twitter handle is at Amelia Bourdeau. You know, so
I'm not that active on Twitter. I have to start being more active on Twitter. I'm a big Instagram person, so you can get behind the scenes kind of stories and trading tips at Instagram at Market Compass if you're on Instagram.
Okay. All right. Well, you know, if you get active on Twitter, I'll support you. So,
thank you so much.
Feel free to tweet in my stream anything you have, Amelia, and glad to have met you, and good hunting.
Nice to meet you too. Great. Take care. Thanks, everyone. Have a good day. Good luck trading.
Amelia. All right. That's it, everyone. Remember, don't just count your pips, count your blessings. You're welcome, and we'll see everyone tomorrow. Adios. Thank you, Amelia.